Hey, welcome back everybody. We're going to do our market update. We're going to get caught up with everything out today. We're going to talk about tariffs, reasons to be a bull right now. Will this stock market rally keep going? We're going to look at a couple news articles covering that. And then we're also going to look at reasons to be a bear right now. So we'll cover both sides of the spectrum. Hope you enjoy this video. Leave a like, subscribe if you want to see more. And I really just hope you enjoy. So today was a really nonchalant kind of day. Not too much happened. We got some Fed speakers, but we didn't get really any major economic data sets, and not much really happened today, as you can see. So this first article we're going to check out is tariffs direction is now clear, how the new economy will look. So we got tariffs now, and these tariffs are expected to change. There are still ongoing negotiations with China. There's that baseline 10% tariff with all of the other countries, and there's a couple things out of that. What's expected to happen is that it will raise revenue and also shift the economy toward manufacturing. This 10% baseline tariff is expected to bring in 1.6 trillion in revenue over the next 10 years. But one catch to this is that they're expecting this to slow growth overall. And then they kind of point out the fact that, hey, like this relief in markets may not last long just because there are tariffs now that we didn't have previously before Trump, right? And that they are now highest levels since 1937. So we're going to look at a few different backdrops. We're going to look at some bullish stock market stuff, and then we're going to look at reasons to be a bear. So the speed of the stock market rebound is fastest in more than 40 years, says Bespoke. And it's pretty much talking about how the S&P 500 up 22% from intraday lows back in April 7th. The last time the index reversed a 15% plus year-to-date decline in less than 6 weeks was 1982. The index will go on to rally for years from there before experiencing its next bear market. So that is a reason to be bullish apparently, because people are expecting, hey, based on previous data where we've seen a similar bounce, that it continued for a while. Then the next article is that stocks have climbed out of a big hole. Here's what Goldman Sachs says investors should do next. So trade talks support this relief rally we're in. Everything's been really event driven based on Trump and tariffs. We don't know what that T-man's going to say or do, but we've gotten more clearance around what's going on. And with the trade deals settling, we had the US and UK trade deals settled. We had China and the US have positive trade talks, and then a 90-day temporary baseline of a 10% tariff on China, then the additional 20% fentanyl tariff. So all of that is looking okay. It's better than where we were. So Goldman Sachs reduces probability of a recession down from 45% down to 35%. Where is that at? I wanted to show y'all that. Can't find it. Anyways, upside could be limited assuming that this event-driven trade continues, because what if something happens and then all of a sudden what we thought we were getting completely changes? That's kind of how Trump negotiates. So assuming that these events keep happening, that's where that upside could be limited. And what Goldman says that investors should do is seek out quality companies, diversify, and Oppenheimer says away from the US and US dollar, and just really stay the course. So this is a positive and a negative at the same time, but the main positive we got out of this article is that Goldman Sachs is lowering its probability of a recession in the next 12 months. And remember, there are no certainties, only probabilities. Now, the S&P could keep rallying in the next months and weeks ahead if this technical pattern holds. So the rally could continue for months. Now, it talks about this zone that included the 3% threshold above the SPDR Spider S&P 500 ETF Trust SPY volume weighted average price shown in this chart down here. Each time the market closed above the threshold after a correction or bear market period since the mid 1990s, the index saw a continuation of the rally in the weeks and even months ahead. So that's looking good, and it kind of lines up with the what we mentioned earlier, that everything's kind of looking good. You know, everybody tried to front run the tariffs, so they bought. So numbers will look good, and consumers are still spending strong. The job market's looking strong. So there's a lot of support for this rally to continue. Now, history suggests stocks will keep on rallying after the S&P 500's 18% rebound. So Jeffrey Rubin at Birani, how the heck do you say that? Birani Associates has taken a look back at how stocks performed over the following periods where the S&P 500 gained 18% or more in the span of roughly 24 days. And he found 6 examples since the 1950s. And in each case, stocks were trading substantially higher 1 year later. Rallies like this occurred coming out of the 1973 to 1974 bear market, in 2002 at the tail end of the dot-com bust, in 2009 as stocks began their slow recovery from the 2008 financial crisis. The smallest gain in 12 months later occurred after a sharp rebound in 2002 when the index was up just 5% 1 year later. The biggest, the S&P 500, was up 46% 1 year later following the market's initial swift rebound from the COVID-19 sell-off. As a result, we expect further gains to follow, Rubin said. So this is all good news. And then there's more good news. Big Tech ETF rises on pace for longest winning streak of 2025. So what we're looking at right here is the Magnificent Seven, and this will include stocks like Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta, and the ETF was on pace for a 5th straight day of gains, which would mark its longest winning streak since longest winning streak of 2025, according to FactSet data. The ETF soared 13.7% so far in May, according to the FactSet data at last check. Despite those strong gains, this ETF remains in red for this year with 2025 losses of 3.9%. But I mean, this ETF being on streak for its longest winning streak of 2025, like right now, we were just talking about all of this support for a good rally, sustainable rally. Looking good, right? There's a trend right there. Now, let's kind of reverse course and start looking at reasons to be bearish, starting with Deutsche Bank thinks the S&P 500's outperformance versus Europe won't last. So a team of strategists at Deutsche Bank led by Maximilian present the chart below to show their trade, yada, yada, yada. They prefer European stocks over their US stocks, but and they've provided a winner this year. However, they note that the S&P 500 has started to outperform their mega, which make Europe great again, factors since the news this week of the US-China trade truce. The S&P 500 outperformance may persist for a while, they say, because American companies are bigger beneficiaries of the tariff cuts. But that will only be in the short term, that they point out, and then they got some reasons for that. So, although lower than feared for now, in our view, tariffs will still be a bigger burden for US companies than European companies. Trump's making an enemy out of everybody with these tariffs. Political uncertainty is still higher in the US than in Europe. Earnings momentum is still more favorable in Europe. Valuations are still more favorable in Europe. Fiscal policy is still more favorable in Europe. The rate environment is still more favorable in Europe. I believe they're still cutting rates. And a potential ceasefire between Ukraine and Russia would still be more favorable for Europe. So these people just don't like American assets right now, and they're eyeing Europe as where the deals are. And a lot of people point out the fact that, hey, everybody's had their eye on US equities for a while, so they're pretty crowded, and that's what's led investors to seek getting away from American equities and American assets altogether. So this is something that they point out that could be something to consider as to why the American trade may not be in for these following reasons. Then this indicator is pointing out that the fact that the NASDAQ 100 nearing overbought indicator. So we're getting this indicator that's signaling overbought, and what it is the RSI, the relative strength index. And just real quick, the relative strength index is a momentum indicator used for technical analysis to assess the overbought or oversold condition of a security. It measures the speed and change of price movements ranging from 0 to 100. Values above 70 generally indicate an overbought condition, while values below 30 suggest an oversold condition. Now, the percent of NASDAQ 100 that is above this 70 threshold is now at 23.8%, which is real close to a quarter. And what we know about quarters, according to this data, this piece by Jamie Chisholm, at the 25% mark, an overheated condition that typically precedes a pullback or consolidation has been reached, he says. So we're very close to this 25% mark, and that's typically where we see a pullback or some type of consolidation. Who knows if that happens or if we just continue based on good news on all of that supporting reason to continue the rally we explored earlier in this video. But that is something to consider, and a lot of people watch the RSI. A lot of hedge funds, day traders, a lot of people consider this metric. So just something to consider. Now, has stock markets epic rebound come too far, too fast? What investors chasing the rally should keep in mind? And what they're really talking about in this article is that investors are chasing this rally. They have FOMO, or fear of missing out. And what's happening is they're chasing this rally, they're buying in, they don't want to get left behind. And it's really led by emotion. And many expect the market to revisit its April lows later this year. And I believe the person that was making that prediction was Paul Tudor Jones, who is a huge name in the stock space. Of course, I can't find it. But yeah, even Wall Street luminaries like Paul Tudor Jones have said they expect the market to revisit its April lows later this year as economic damage from Trump's tariffs is finally felt. And it goes back to what we've talked about in earlier videos together, where we were talking about interest rate cuts with the Fed, or them hiking interest rates, the Fed funds rate. And that's not felt instantly because not everybody goes and applies for a loan all at once. So the Fed funds effective rate, when it was raised, wasn't felt by the economy yet. It takes about 12 months to 18 months to finally start kicking in. And they're saying the same thing about tariffs. Now, it might not be as long that it takes for the economy to start feeling these tariffs, but it's there and it's going to start kicking in. And the longer they're there with these high rates, that's just more of a chokehold that both of these factors have. Just imagine a double chokehold. Interest rates, tariffs, just double choking the economy. So those are things to consider. And then it mentions the fact that the market's raced from oversold to quickly overbought, and mention that RSI indicator we've mentioned, and a couple reasons. One of the reasons being, we just talked about the RSI and the market being oversold to overbought. And another thing is that this tariff agenda remains unsettled. So, and mainly with the US-China trade truce, anything could happen out of that. Right now, it's looking all roses and sunshine and happiness. I mean, a 30% tariff's not great, and nobody really wants the 10% tariff either, but we'll take 10% or 30% before we'll take the 145%. That's a lot lower. But anything could happen, though. Anything could literally happen. And let's say somehow Trump or China, one of the sides gets pissed off at the other, and then it's bad news again. The stock market will revisit some lows in the case that some black swan event comes out, or this trade war deepens and starts unraveling all the truces we had, and then there has to be a reaction from either of the sides. You know, between me and you, Trump. Now, retail sales data coming, and American spending looks to have slowed down. So this just visits American spending habits, and after Americans pulled forward many big ticket purchases in March to get ahead of potential tariff induced price increases, spending is expected to be more muted in April because they've already did their spending, right? The control group of retail sales that excludes purchases of auto, gasoline, building materials, and restaurant dining for a more consistent measure of spending is expected to gain 0.4% in April, the same monthly rate as March. The control sales group is worth monitoring because it feeds into calculations of gross domestic product, GDP. Retail sales likely tumbled in April following a one-off jump in purchases of autos and big-ticket durable goods in March before tariffs hike. Economists expect to see a pullback in auto sales in April. March was a blowout, yada, yada, yada. However, the team is anticipating another strong month of restaurant sales, a good indicator to watch for early changes in American spending habits. While the consensus outlook for retail sales data is for a muted increase, the range of estimates is wide, with some economists predicting an outright pullback of 0.5% and others expecting flat growth in sales. Everybody's going to be watching for signs of a weakening consumer, and we're already kind of getting that. So as this data continues coming out, we'll try our best to cover this together, but here's another thing to just kind of throw on top of the haystack of reasons to be bearish. So we've talked about a couple bullish articles and then a couple reasons to be bearish this market, and who knows if this market continues going the direction it's going. We see QQQ is it's going down in the after hours, so that's just something to consider. Then we got a couple Fed speakers today. Philip Jefferson was the one I wanted to point out, just because Chris Waller, I believe, was the other one, just kind of talked about the importance of Fed research for monetary policy and jumping ahead of all those trends. So just to save us some time right now, Philip N. Jefferson had a speech about economic outlook, and I got a summary right here just for us to go through and read together. So let me just pull this up. Control A. Come on, what are you doing? How do I open this thing back up? There we go. All right, and for some reason it's not showing me it, so let's do Alt A, Harpa. So here, we'll just read through it real quick because it's not coming up in the video. All right, and there's the speech. Yeah, the Chris Waller, Role of Economic Research in Central Banking. All right, here we go. It came up. So Vice Chair Philip N. Jefferson presented an economic outlook at the Federal Reserve Bank of New York. He recognized the contributions of the second district directors, yada, yada, yada. The economy displayed resilience in the first quarter despite heightened uncertainty, with GDP contracting slightly after strong fourth quarter growth and private domestic final purchases showing robust momentum. Consumer spending showed strength but experienced fluctuation influenced by weather and trade policy expectations. Trade policy changes have led to declining business sentiment and potential price increases for consumers, prompting a reevaluation of economic growth expectations. Labor market conditions are solid with low unemployment, consistent job growth, and balanced job vacancies, although potential cooling is anticipated due to trade influences, mainly these tariffs. Inflation is trending towards the Federal Reserve's 2% target, but faces challenges from potential tariff-induced price pressures. Recent monetary policy held the federal funds effective rate steady, positioning it to respond to economic developments with an ongoing assessment of data and policy impacts. The speech emphasized the importance of information from diverse sources for effective policymaking and heightened Jefferson's focus on the dual mandate of employment and price stability. So we already kind of knew all this was going on, but I think this is a solid video, y'all. We looked at some of the news articles that came out today. Reasons to be bullish, reasons to be bearish. We talked about how this tariff direction is clear and that tariffs are higher than we've seen since 1937, or the highest level we've seen since the 1937, and that yeah, it's going to bring in revenue, but at the same time it's going to slow overall growth in the economy. We're going to keep on watching this together. Y'all stay looking out for the updates from me. I'm going to do my best to keep these videos coming. We just hit 20 minutes on this video. I feel like this was probably one of my better videos I've done. I'm super proud about it. But y'all, I hope the day is great for you. And have a good one. I'll keep these videos coming and enjoy the day.